most of those people probably are going to add gold, silver, commodities and deleverage away from stocks. I think a lot of people do that, but the people that are actually going to go towards it, like you said, they don't even know it. They don't even know it. I can give you one example. Some of these risk reward stocks in the miners are unbelievably good. I mean, the risk reward is so fantastic, it blows my mind.
Welcome back to Metals and Miners. I'm its founder and its host, Gary Bohm. Today we have a great discussion lined up, and we're fortunate to have with us Don Durrett. Don is the author of How to Invest in Gold and Silver, a complete guide with a focus on mining stocks. He's an expert on gold and silver mining stocks. Don is a frequent guest on investment podcasts and is the founder of goldstockdata.com, a gold and silver mining equity data website. Don, thank you so much for joining us today.
Hey, Gary, first time. Thanks for having me on.
Yeah. So neither political candidate is committing to balancing the budget. The political class has essentially given up on that idea. It's likely because they know that nothing stops this train. What are the ramifications to this ever increasing deficit spending trip that we're on? And how do you see it impacting the everyday folks out there? And what are you anticipating the impacts also to be on the mining complex because of this?
Yeah, this is a question I literally could talk for 30 minutes straight. And the reason why is because the debt bubble has gotten so large. I mean, we've been doing this for 30 plus years, and now it's reached $2 trillion. This year, we're at $1.8 trillion deficit. We've been adding debt since 2008. We averaged from 2008 to 2020, we averaged 1.3 trillion in new debt deficits, and now we're at 1.8. And so, yeah, we haven't even talked. It actually stopped in 9/11, 2001. Since after 9/11 happened, there's been no talk of budget balancing. It hasn't come up at all. It's just been just keep spending money. And people think that we can do this forever, that we can just keep kicking the can down. And I've been saying that, no, that's not true, that eventually what you end up with is a doom loop. And I think we're almost there. And let me explain what I mean by the doom loop. So right now we're borrowing about $150 billion a month. If we go into a recession, which I think we will, the deficit is going to go above 2 trillion. So let's just use 2.4. So that gives us $200 billion every month we have to borrow. So if you borrow 200 billion, it's a lot of money. Who's going to come up with that money? Well, the Fed is going to have to basically jump in. And once the Fed has to, let's say that they have to do about 50% of the auction, which would be $100 billion a month, people are going to start to recognize that they're printing money. Every month, the Fed just keeps injecting money. Now, that can be good for the economy because it's like QE, but the ramifications, the doom loop is that it causes inflation, and inflation damages the economy, which is the reason why they've been raising rates and the reason why they had QT for the last 2 years, because inflation is dangerous. So you get this doom loop where they're printing money because they have to. We can't stop spending money, because if they stop spending money, if they try to cut spending, then that's going to hurt the economy right when we're going into this recession. So they can't cut, they have to keep spending. And then the Fed has to print. And so you get into this doom loop where foreigners start dumping their bonds because the dollar keeps getting weaker. It's like, wait a minute here, how do we get out of this hole? How do we get out of this problem? And there isn't a way out. So this has been building for 30 years, and now we're there. So the people that think, oh, we're going to kick this thing down the road, the odds are in their favor. It's getting very precarious. I mean, we've been talking about bond problems, tail risk, since last October. It's kind of started. And every one of these auctions, they start talking about this tail risk. And basically the tail risk is that people don't want to pay what the auction started out at. So the auction will start out at, 5%, and then people are bidding 5.25. It's like, whoa, wait a minute here. and that puts upward pressure on interest rates. And so that's what's going to happen is these auctions are they're going to start going up, pushing rates higher. And so it's a big problem. The debt problem is a big problem. And ultimately, the reason why I'm in this is because I believe that the U.S. bond market is going to break down. And when it does, the beneficiary is gold. People think, well, the bond market will never break down. Well, I just gave you the scenario that it can, and it likely will.
So, Don, the economic data, I think you kind of touched on it, is deteriorating. If the U.S. enters recession, what do you anticipate happening to gold and the miners in that situation?
Well, initially, I think that the stock market, once we start into recession, so right now the stock market is bullish because GDP is positive. They expect interest rate cuts, which will keep GDP positive. And the consumer hasn't fallen out of bed. The consumer numbers are not terrible, but overall, I think they're weakening. And then the jobs numbers are weakening. And we went from somewhere around 3.6, now we're up to 4.2, 4.3. So there's something called the SOM rule. So once unemployment gets above certain levels, 100% of the time you go into recession. So yeah, the economy is definitely weakening. And so even the numbers that Wall Street is using are starting to wobble a little bit. So I think initially what's going to happen is as we go into recession, as we start into recession, I actually think that Wall Street will probably lead that. So once the S&P 500 gets below 5,200, that's when it starts to get nerve-wracking for Wall Street. I think above 5,200 and they're in the kumbaya mentality, everything's fine. We're just going to bounce here. Anything above any correction that stays above 5,200, they think it's just a minor correction. We go higher kind of thing. So you go below 5,200 and then it really becomes dangerous. And then you have two more levels left. You got 5,000, 4,800. So I think the recession starts the moment we go below 4,800. Now, if that happens, I think that's gold and silver mining stocks and gold will go down with the market. Everything will go down. Possibly even the dollar will go down, which is ironic because the dollar is usually a safe harbor. But everybody knows we're cutting rates. So is the dollar a safe harbor? And so there isn't any place to hide. Even bonds are like, oh, I'm going to go to bonds because they're lowering rates. But if inflation comes back, then you lose money on your bonds. So even bonds are not a safe harbor here. And so but I think that gold has been leading all year. Since March, gold has been unbelievably strong. Gold is not the pretender here. Gold should not be at an all-time high when the stock market is at an all-time high. Those two guys are nemesis. They're not friends. A strong economy is not gold's friend. When gold's high, everybody goes, what in the heck's gold's doing high? Gold's the red flag here. Gold's not the pretender. And if you look at, when you have bull markets, it's never happened before where if gold is in a bull market, which I think it is, I think it started as bull market in March or the first week of April. I think gold resumed its bull market. It never, basically, if it is in a bull market, you never see a breakdown. I don't think gold's going to break down here. So I don't think we retest 2,100. The breakout was 2,070. I don't think we're going there. I think 2,200 is the floor, and it's possible 2,300 holds. So if gold is not going to break down, all we're really going to see in the miners, we're going to see gold go down 5 to 10%. And this is my, best guess. I see gold going down 5 to 10% with the markets. And then that's as low as it goes. So the market keeps going down. Gold's going to decouple and go higher. So if gold's only going down 5 to 10%. So if 2,500 gold right now, if you do 10%, that's $250. That takes you to 2,250. And that's about where I expect it. 2,250 area plus or minus $100 is where I expect gold to bottom out the cycle low. So if gold goes down 5 to 10%, that means the miners will go down 10 to 20. So right now I'm on the sidelines. I always buy like the first of the month. I usually buy miners, my cash flow of the first of the month. I'll buy miners. I haven't been on the sideline in 4 years. I have not been on the sideline in 4 years because we've been in this correction. I mean, so this is the first month, this is the first time I've been on the sidelines. So I'm waiting. I might not buy any miners in first week of September. I'm going to Beaver Creek though. I might find a miner there second week of September. But my plan is to wait until the correction comes in the stock market and then buy that dip. Basically, I'll probably wait for 4,800 on the S&P when I jump in.
So investors long ago moved into long duration assets like tech and artificial intelligence stocks, which really choked off capital to the physical market. Is that huge shadow, in your opinion, of the tech and AI stocks beginning to shrink at all, now exposing maybe some opportunities in the old economy to investors once again?
No, no. I think this is a paradigm shift for the worse for the U.S. I don't think we recover from this. I don't think this is a standard business cycle. I think that Wall Street is really making a big mistake here by not paying attention to Jeremy Grantham, who's probably our greatest economic historian living. And Jeremy Grantham said that this market is the most vulnerable ever. I mean, he's even including the 1929 crash, the 1920. So this is the most vulnerable market ever. And the reason why is because if you connect all the dots, America's in big, big trouble here. Economics is only one side of the coin here. You also have our political problems and our social problems. They all are coinciding together. I don't think that America recovers from this election. And this isn't something I've been saying just now. I mean, I'm saying it for a while that this has all been kind of leading to this outcome. And you can see it. America has been the dominant country since the end of World War II. And that domination, that hegemony, if you will, is ending. I mean, all you have to do is kind of connect the dots. I mean, it all started with the Ukraine war. That war really shifted. You know, Russia and China should be enemies. They're natural enemies because they're both competing for that Asian area. Somebody wants to dominate an area, right? They're natural enemies. And so now they're best friends. And so that coalition is expanding. You know, it's called basically the BRICS, but they have two significant coalitions. They have the BRICS coalition, which is growing, and then they also have an Asian economic partnership. And both of those are growing. Both of them become much stronger. And so they're diversifying away from the dollar. They're diversifying away from America. They're diversifying away from our bonds. We depend on the world, and especially these Asian countries where most of the economic growth is occurring, to buy our debt. And now China, they stopped buying our debt, I think in 2014. Most people aren't aware of this. But if you look at the chart, China at one time had over $1 trillion in our bonds. Now it's below 750 billion. So that's more than 25% that they've sold, and they're not buying. And Japan has over $1 trillion, and I think that Japan will start selling as well. They won't be buyers. So this whole global dynamic is massive. And then when you couple that in with what's actually happening with the U.S. economy, all we have to do is look at the average middle-class family or the 50%. Yeah, 40% of Americans are doing great. Not great might be might be a little extreme, but 40% of Americans still have a fantastic lifestyle. You know, and it gets better as you go up, you know, the top 25, the top 10, the top 1. But about 40% are living their lives, you know, they're doing their thing. And America still has that high standard of living. I call it Easy Street. So we're still on Easy Street for about 40%. But guess what? There's been a big dramatic shift since 2020 for the lower 50%. That lower 50% now is struggling. The lower 50% cannot pay their bills. Every month they're deciding what can I include in my budget and what do I have to exclude. This is a big shift, and it's something that's getting worse. It's not improving. Like I said, inflation's not going away. So people say, well, inflation is under control. Well, guess what isn't under control, what isn't under control is budget. So the budget got basically rug pulled, and those costs are not going down. Your insurance isn't going down, right? Your food bill is not going down. Your rent's not going down. So all of our costs are high and they're not going down, and we're trying to catch up. But catching up, it's like once you get behind the eight ball, it's really difficult. So your question was, are there other opportunities here? I'm saying no. I'm going to bring in the Hugh Henry line. He goes, I suggest you should panic. I mean, that's where we're at right now. We're literally on the threshold of the whole country getting rug pulled. In other words, Easy Street's actually going away. I actually think Q4 is going to be wild. And in 2025, I don't know when America is going to realize that we're not going forward, that we're going backwards. And we got a problem there. There's no way out. But I think it's going to be after this election, Q4. It might take all the way through 2025, but when we get there, we got a big problem here.
So it sounds to me like you think there's going to be a widespread sell-off, deleveraging event in the markets to take place, maybe across all markets, real estate, everything.
Yes.
And so it'll be a massive deflationary impulse
for assets. Yes.
Okay.
But I don't think we're going to crash. I think it's going to be a steady, slow decline. And the reason why I don't think it's going to crash is because you have this normalcy bias that the Fed can save us. And so Wall Street is basically going to say, don't worry, everything's going to be fine. We just need one more cut. We just need one more cut. So everybody's going to try to hang in. So I think it's going to take at least 3 months, maybe 5 months to get a bottom here in the market. But I think the bottom is going to be somewhere around 3,000 on the S&P. But it's going to be a slow slog to get there.
And so, that kind of massive move would imply some massive unemployment and hardship for folks out in the general economy.
Which hasn't happened since the last time we had inflation. 78, 79, 80 was really the last bad recession we had. But you could say that the dot-com bubble was awful, but that was more high-tech related. Most of the layoffs were high tech. Most of the other industries, and the 1990 recession was pretty mild. So most people have not lived through a serious recession,
right?
And we're about to have our first one, and we're going to have it during a period where everything is highly leveraged. Consumers highly leveraged, corporations are highly leveraged, the government's highly leveraged.
Yeah.
And so what's going to happen? It's going to be really nasty. I don't know the exact. How is it going to play out exactly? But we have a pretty good idea. You mentioned part of it. Unemployment is going up. It's going to be hard to replace your job. That's very serious. But once it starts, at a certain point, the government is going to realize. I don't know how long it's taking. It might take 2 to 3 years for this final outcome. But at a certain point, the government's going to realize that we have to cut our budget. Because we living off debt has caused this problem, and more debt is not solving it. So they're gonna try to print money and add more debt, and that's not going to work. So at a certain point, they're going to have to cut, and when they cut, that's really when we get rug pulled. So the next 3 years, 25 through 27, are going to be really, really nasty, and I think it culminates in 2027. I think that's going to be the bottom, if you will, and then we start climbing out, but. The climb out is not going to be what people expect, because the climb out is going to be into a new era, a new America, a different America. Massive shift, because if Washington doesn't solve our problems, 25, 26, 27, we're going to give Washington 3 years to fix this problem. And they're not going to fix it. So after 27, we're basically going to turn our back on Washington, and the states are going to fix it on their own. But that fix on their own will start before then in some states, but it will start with all states. So Washington will basically be marginalized in 27, 28. It will no longer have its impact. This will be the last presidential election because in 2028, Washington would be so marginalized. Everybody will go, what's the point? There's no reason to have an election.
So Okay, I'm going to shift this a little bit. Why is now a time that the everyday investor needs to be paying close attention to and have some exposure in the natural resource sector?
Most of the people that have already done that have already figured it out. And those that will move into gold, silver, natural resources, commodities, the people that are going to do that don't even know they're going to do it. I've been saying the people that are going to buy silver don't even know they're going to buy silver because we've been in this normalcy bias. Nobody's been in a bad recession. Everybody thinks that we have the strongest economy in the world because we have 25% GDP, but it's actually a very weak economy. It's very illusionary. It's all based on debt. And so the average person, like I said, the people that are watching this, they already know. People are watching Metals and Minerals. They already know. They figured it out. This has been going on for a long time. And so people that are in, but some people that are watching this are thinking, should I add more? Right. And they'll figure that out. They'll decide. They'll watch the markets. But most of those people probably are going to add gold, silver, commodities and deleverage away from stocks. I think a lot of people do that, but the people that are actually going to go towards it, like you said, they don't even know it. They don't even know it. I can give you one example. Some of these risk reward stocks in the miners are unbelievably good. I mean, the risk reward is so fantastic, it blows my mind, and nobody's buying them. And there's clues all over the place at the risk reward. I'll give you one example is Free Gold Ventures. So Free Gold Ventures has 20 million ounces of gold in Alaska in a good location. And they're selling, and the gold in the ground is selling for $10 an ounce. And Eric Sprott just keeps buying more of it. He owns almost 30% of the company, and he just added more. So he might own 30%. And there's another group that owns as much as him. And those two groups together are not selling they're not selling the company. And they're basically going to sit there and wait until somebody pays $100 an ounce. And nobody's buying the stock. It's insane. It's like people are going, well, because, and here's the kicker, is that nobody will build that mine today at $2,500 gold. They might, I mean, it's probably economic, but the CapEx is so big that probably nobody would a big 20 million ounce, kind of low grade, six grams per ton mine, people aren't going to mine it. So everybody's going, well, I'm not going to buy that stock. It's never going to get built kind of mentality. And Eric Sprott is like, it sure is. And I'm going to keep buying more. Eric Sprott's a billionaire and he keeps buying the hell out of the stock. But Wall Street, they don't have a single share. The average person, nobody's buying it. But the risk reward in that stock, like I said, is just off the charts because gold's going higher. So gold's higher, that at some point, somebody's going to want to build that mine. And they're basically saying they're going to call up and say, yeah, we're interested. And they're like, fine, yeah, but here's the price. Mm-hmm. But nobody's going to pay a 10x premium today. But what's going to happen is that if you own the stock today at $10 an ounce, is that I have a spreadsheet that has 55 stocks on it that are optionality plays. For gold miners, it's gold and silver, but the gold miners on there, they run from $5 an ounce in the ground to 15, and there's like 35 of them. So Free Gold Ventures isn't that unusual. The thing that's unusual about Free Gold Ventures is the location and the insider ownership is so strong. But some of these other companies that are trading at $5 and 15, they have other issues. But my point is that all these mining stocks that have gold and silver in the ground at these levels, at a certain point, M&A is going to begin. And so you're going to have like 3 rounds of M&A. And each round, when I say a round, like let's say every 6 months. So every 6 months, you have like maybe 10 deals. And those deals each one will be a little higher. They'll keep going higher, right? Because of comps, right? So the first ones will get done at about $25 an ounce, first round. And then the next round, they'll get done about $40 an ounce. And the next round after that, it'll probably jump up to $70 an ounce. So you'll have like 3 rounds. But if you own this stock, then every round there's an M&A deal, the rising tide is going to lift all boats. But my point is this, is that the risk reward on these stocks is so much better than NVIDIA or the Mag 7. The Mag 7, the risk reward is awful. You might get from here forward, you might get lucky and get 5 to 20% on your money each year, maybe, but you might lose money. Whereas these stocks, the risk reward, I think, it's long term. I mean, everybody thinks in quarter. They're thinking wrong. If you think in terms of 2 years out, okay, I'm going to buy the stock and wait 2 years, you're going to get, and again, gold goes to 3,000. The risk reward is phenomenal, and nobody's buying these stocks.
So there's a lot of pieces to what you just said that we're going to talk about, but I want to ask you this. Gold is blasted to new all-time highs this year, making something like 35 new all-time highs since March. Yeah. It's now over 2,500, and that's less than 2 years since it was in the 1,600s, and some analysts were saying it was headed towards 1,200 or lower. I'm sure you remember that time. Yeah. What does the ripping higher of the gold price say to you is going on in the broader financial markets and economy?
Yeah, and I alluded to this earlier about the global hegemony problem the U.S. has and this shift of international trade globally. This is, the dollar has been the reserve currency since the end of World War II. And because of that, all these countries are sitting on dollars and they buy our debt. Well, as that starts to change, it creates a lot of uncertainty. People don't know. And I'm not the only guy that knows how to, connect the dots and analyze things. These foreign countries, everything I said about the negativity, all these things, pushing up against the U.S., other countries can see this as well. So you have central banks around the world, not the U.S. central bank. They don't buy gold, but all the other central banks have been buying gold. And investors have. I mean, the one thing that's really driven up gold has been central bank buying. And they're buying it because of this uncertainty. They're like, what's the next Bretton Woods? How does gold play into that? What are the BRICS currencies going to do for their cross-border transactions and trade? How are they going to resolve that? Are they going to use gold? And so gold is basically, it's an indicator that basically we have this shift, this paradigm shift in the global financial world. And so gold is leading that charge. And so that's why it's doing so well.
Yeah. So there's been other errors where there have been lots of tensions, economic, geopolitical, political, currencies, etc. How does the current environment for gold today compare with previous periods, and what are the implications for, price and investments?
Well, gold was basically convertible in the U.S. until 1971 when Nixon took us off the gold standard. And gold at that time was only $35 an ounce. $35. We're at $2,500 right now. But just think about that for a minute. Yeah. So basically, until it became a new world in 1971, and so we have to look at it from 1971 forward, and then you have to look at what transpired since then. And what transpired since then was the U.S. was basically a mercantilistic economy until 1970. 1971, we had no debt. We were the manufacturer of the world, in the 50s and 60s, and then the world started catching up with us, and they caught up with us in 1970, and we were no longer this mercantilistic society. So in the 70s, we didn't know what to do. We didn't know how to pivot. It's like, okay, what do we do now? We didn't know, and then we had the oil crisis in the 70s. We had two of them, and then everything changed in 1980 when Reagan got elected, and Reagan basically said, okay, we're going to use globalism because we can't compete against these guys because they have weaker currencies than we do, and they can charge less labor costs. So the path forward is to use globalism and let our corporations go and make stuff in China and then import it back to us at cheaper prices. That was globalism. And then Trump and Reagan basically implemented globalism, and in tandem with that, he called it the free trade movement. And the free trade movement was basically globalism. And so you make these free trade agreements that allow us to make stuff in a foreign country and then import it back free, and right, and then we can export stuff to you. But globalism and free trade are kind of synonymous. But everybody thought that was a good thing, and everybody said, "Oh, this is going to work," right? But it was an experiment. But anybody that understands economics knows it was basically it wasn't going to work for the middle class, because the middle class benefited from making stuff, and now we're not going to make stuff. Like, we don't make appliances in this country. We don't make any electronics in this country. It's all in it. We don't make any drugs in this country. All the drugs, basically, most of the stuff, that we use on a daily basis is imported. It's unbelievable. And that all came out of the 1980 decision to go towards globalism. And now it's in order for us, because we're not generating enough wealth, because we're not making stuff, the middle class, their standard of living has steadily declined to the point that we're at today, where it's going down instead of up. So our standard of living is going down instead of up. But the top 25%, the only reason why their standard of living is increasing is because of debt expansion. So debt expansion only benefits really the top 25%. And if you look at the top 1% from 1970 to today, it's unbelievable how much they have benefited. And the reason why is because the U.S. in 1970 finance, New York City, their percentage of GDP was below 10%. Below. I mean, I forget how much lower it was. Below 10%. It could have been well below in 1970. Today, finance is over 20%. So that big shift of basically GDP going to financial instruments, all that debt that keeps getting created, right? They call it the Cantillon effect. The people that get the debt, they benefit first. And it's Wall Street, because they can buy these bonds. They get the money first. They benefit first. So we financialized our economy, which has hurt the middle class. But it's helped the top 1% immensely. And it's broken everything. And so our economy is broken, which has broken the political system as well. And there's no way out of this. We're trapped. That's why I said earlier that the next 3 years is basically going to be kind of ugly economically, and a shift. America's going to, after those 3 years are done, America will basically pivot into total reorganization of how society works.
Well, speaking of pivot, let's pivot over to silver here briefly. Don, many analysts point to the gold to silver ratio for determining whether or not they should invest in silver. When the ratio is high and it's stretched past its historical mean, they buy more silver. When it's lower than the mean, they sell. The ratio has been stretched far beyond the mean for several years, many years. Silver's running a supply deficit for at least 4 years. And the applications that are requiring silver, they're just exploding, creating more demand for the metal than ever. What does your analysis point to for silver? I want to point everyone over to our Substack. It's free. Go to metalsandminers.substack.com. We post free content on the consumer, economy, markets, artificial intelligence, individual metals and miners, and every single expert interview, just like this one that we conduct, they're all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote, and it's based on the important Ray Dalio foundational premise. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." This free gift, it's a must read for everyone on why we all should own gold. So head over to metalsandminers.substack.com. Put in your email address to subscribe and receive the free gift on us. Also, I'm positive that you've enjoyed the conversation with Don as much as I have. Please let him know. Hit the like and subscribe button and leave a comment below the video.